back, everyone. Welcome to this beautiful day for trading. It is Saturday, and what we're going to be doing is just a little bit of trading. So, we're actually going to learn the basics of trading. So we're not going to do too much trading, but more just the basics, really. Okay, so let's get to it. So let's make sure that we are live. Are we live? Yes, we are live. We've been live for 22 seconds, which is amazing. Now, let's just go to the trading screen. I just want to make sure this thing comes up, and then we will get into all the trading stuff. Today, so I'm not going to be giving any trading advice or anything like that, or financial advice. And you know, like, also go see a financial professional. This is not financial advice at all. It's just for educational purposes only, right? Okay, cool. So that's okay. The preview is not coming up. Maybe I'll give it a refresh, and then let's get into what we need to get into. Connect encoders. Yes. Okay, cool. I think it's happening. It's all happening. It looks good. Now, let's get into it. So we have a crypto trading platform here, right? It doesn't matter which one. They honestly all look the same with the same features. And now we're just gonna go through each little component of this and try to just debunk what is going on, right? Now, so you've just got a lot of things going on here, right? There's like all these things, and then you click on a tab and it pops out to like all these like these futures, and then this kind of futures, and then what is a coin M futures. We'll go through that real quick. And then you got silver and gold and oil, and oh my god, and then you've got zero fees on. So there's a lot. You got to be real careful about what you're doing and making sure you're not just getting tracked, like lured in to all this stuff. Okay, cool. And you got a bunch of stuff here that's like, oh, you could get a $10,000 if you do something. So be careful of all that stuff. Now, and then so you got here wallets. Now I funded this account with a little bit of money, nothing too crazy, just for educational purposes only. And you've got messages, QR codes, settings, all that silver is who knows what. And then okay, so let's move down a little bit. You've got how-to guides about how to transfer, blah blah blah. So let's just move it down a bit. Let's go here. So here, this big thing here, you've got the chart. You've got the chart, and you can look at the chart with different views. So you got the original, which is the native one the platform offers, or they often prices are sort of integrated into TradingView, and then they put the TradingView widget on the platform, which is nice. I think TradingView offers quite a lot, for traders. Then you've got this depth chart, right? Which is just completely different to what the other ones look like, and we're going to discuss what is going on here exactly, right? Cool. Now, and then you can adjust the range, which depths you want to look at. Cool. Love it. So let's go back to TradingView. And now, so this is on the 1 minute time frame. So what this means is each of these bars are 1 minute, right? Each of these bars are 1 minute. And I'll explain what the red ones mean and the green ones mean, right? So and we can go the 5 minute. So each of these bars are now 5 minutes long in time. And then maybe we can go to the 1 hour chart. Now each of these bars represent 1 hour in time. Cool. We've got just a lot of things floating around. It's crazy. There's like a lot of stuff going on. And then what you can do, you can change the type of charts here. So maybe a line chart. Now there's lots of different lines. These are called indicators. You can just add them. So let me just take them all. I'll explain them, then I'll take them all off, right? And so this is the line of the price here. But sometimes candles are what I'm used to, so I'm just gonna put those back. Now these things are indicators, and to add indicators, you just you go here, indicators, and then you can choose whatever indicator you want. Now, I'm not going to give you any advice on which indicators to use because they're a double-edged sword, you know? Sometimes you can make yourself believe anything with them. So you got to be real careful with those. Okay. So this is the EMA, the exponential moving average, which is it's a moving average that weights values closer to the current time, essentially. So if this is a 5 exponential moving average, right? So it takes the last 5 periods and then takes a average and then puts weights sort of closer, right? Here, a 60 EMA, so it'll take the last 60 and then do that, right? Now, I have these as percentages here, so I'm just going to take that off so it's a bit more informative. I'm going to get rid of these EMAs. Yep. Okay. So, does anyone have any questions thus far? Anything that is a bit crazy? Let me know. If not, I'll move on. Okay, cool. Let us move on now. So this on here is the price of whatever asset you're trading here. We're going to be doing a Bitcoin perpetual futures, which I will explain soon. Now, yes. And so, so you've got the price here. And now I'm going to explain what each of these candles mean, right? So you've got 2 different types of candles. You've got a green candle or you've got a red candle, right? So the candle represents 1 minute of time. So if we zoom in, like this length from here to there is 1 minute on the graph, yeah? And so, you know, you go 1 minute, 1 minute, 1 minute, 1 minute, 1 minute. Now, a green candle, what a green candle means is within this minute, the price the candle started, which we call the open price, right, that is below the close. Or maybe a better way of saying that is the close price where we finish is greater than the opening price, right? And then if we have that condition, so where it finished, it's green, right? If the price increased by the time we finished that candle, it's green. And then but if it didn't, so if it goes down during that minute, if the close is lower than the open, so here's the open, it would be red, and here's the close. So this is the open, and this is the close, because this one's red. This is green, so that means this one is going to be the open, and this one is going to be the close, right? Now, so that's half of the candle story. That's half of the candle story. Now you've got these little, we call these wicks on the end, these little lines. If you see, we've got one below the candle, like one below the middle and one above the middle. So what these lines represent are the highs and the lows. So here, so the bottom of that wick there, that is the lowest point. So if I go there, the lowest point was 69,907, right? And then the highest point there, I'm pointing to that thing there, it was 707.14, right? So this is the lowest price and this is the highest price. And then here for the red candle, this was the lowest price of the red candle, and then it looks like the open price was the highest price for that red candle, right? Because there's no wick. So if a candle doesn't have a wick, it means it's either the open or the close with like the extreme values of that, one of the extreme values of the price, depending on the color of that candle. Now, that was a lot going on there. Does anyone have any questions before I move on? It takes a bit of time getting to look at them, but it's okay. So we're looking at this chart, right? So I'm looking at this. Look at this candle. We call this, I think, a doji candle or something like that. But what this means is, I would say, so it opened here, and then it wicked down. It wicked down sharply, right? And then it must have come up, or it either went up and then wicked down. Yeah, so there was a lot of sort of movement here, but it ended up closing close to its open, right? So I guess you know, if you place an order there, you could get a limit order filled, right? So you know these, but this one, like this candle looked a little bit more stable. I mean, it has a high wick there. This, yeah. Okay. So you often see this kind of thing in the market, right? Like if something's like going down, it's going down, it's going down, it's going down, and then when the momentum stops, it'll sort of come down and then revert up, and then it'll sort of stabilize a little bit. Sometimes you see that kind of thing. Okay, cool. Any questions at all? Otherwise, I can move on. Okay, cool. Let's move on. So you've got these bars at the bottom here, and so what this is, that an indicator? Usually, so sometimes I like to put the volume. That is important to sort of, you know, see how much is being traded. So volume. Let's see. So volume is just how much is traded, right? Volume. That's what I want. Yeah. So, you know, green just means it was a green candle, red means it was a red candle there. Now, so these high bars of volume means there was a lot of activity, buyers and sellers transacting quite a lot here. So the volume there was high. Here, you know, less volatile and not many people trading. So here we've got sort of a lower volume there, right? Okay, cool. So that's the chart. That's the chart. Now, if you're sort of, you know, click trading and stuff, maybe, and you are a technical analysis dude, you probably want to be looking at that, and you can draw some lines. You know, you get all these lines here, and you draw, like, I don't know, all kinds of flags and supports and resistances, right? But I'm not, like, at Coder Trader, we're not too concerned with that. We care more about the order book and a bit more like higher frequency trading. That's okay, you know, some traders enjoy that. Some people do chart stuff. I don't want to say one is bad or one is good, you know, because some people are successful doing this chart stuff and some people are not. But yeah, so that's all I'm going to say about that, I guess. Now, what we're going to do here is look at, so this is the order book. So this is what Coder Trader is really concerned with. So here we've got the order book and we've got the market trades. So let's look at the market trades coming in, right? So what this is, it looks like it's continuously moving, right? So these are just moving down, and what each of these represent is someone buying or selling. So in real time, this is like people who are, so these are like these are buys, this is sell, reds are sells, greens are buys, and then here you've got the quantity here, and then, you know, at what time it transacted, essentially, right? Now, cool, that's all good, and that'll tell us a lot there. Now, we've also got the order book. So this is sort of what just happened, what just happened, like right now. And then this is the state of the order book. So the order book is a very important topic in trading and things like that. So it tells you how many buyers and sellers are in the market, right? Now, let's think about what's happening here. So you've got all this green and you've got all this red, right? And so let me demonstrate with maybe these cardboard boxes, right? So you've got on the bottom people who want to buy, and then you've got on the top people who want to sell, right? So they have these. So maybe I can make a little. No, I can't. I need two hands. That's okay. So you got people who want to buy and you want to sell, and then as the market moves, you know, their prices change. And so what's really happening is the space in between these cardboard boxes is called a spread. It's called a spread. And so the spread is the difference between the best, we call this the one on top, the best offer and the best bid. And so these two don't trade. These two don't trade because this guy wants to sell for high price, but this guy wants to buy for high price. If they agreed, they trade, but they don't agree. They don't agree, right? So that's what's going on there. So that is what's going on there, and they don't agree, right? So you've got 80 here, and you've got 600, so 590, 600. So they they disagree by $10. And how this is linked to the last trades is that some dude, some actor in the market, he will either want to buy or sell. So if he wants to buy, he'll look at all this, he'll look at the best seller and say, okay, cool, I'm gonna buy some of that. I'm gonna buy some Bitcoin at that price, right? And then how much Bitcoin is available at this price? It's about 2 million worth there, right? And same, so but if some guy wants to sell some Bitcoin, you know, he'd look here, he'd look at this and be like, okay, I'm going to sell it at this price. So that's what sort of is happening there. So you've got this order book, and then this is the, you know, and then so every time you get a transaction, it'll appear here, and then so like a red one, yeah. So they come in and then they're just taking off. We call it taking liquidity, right? But if you add to the order book, that's, you know, giving liquidity to the book. Now, offset. So what sort of drives price? So this is the last price. So when you think about like how does the order book and last trades relate to like the price of Bitcoin when you Google it? So when you Google the price of Bitcoin, right? What is actually going on? Now, it could be a few things, right? It could be maybe one of two things. Maybe it could be a moving average or something, but it could just be the middle point of the order book here. So that's 90 and that's 600, so it could be 95. Or sometimes they refer to it being the last price. So this is the last price here, right? The last traded price, and that changes a little bit more. Okay. Cool. Or people like have some average and they take some weighting of the last price and maybe the mid price and the volume or something like that, right? And sort of this is a whole topic in of itself, like understanding how to price things, and this is particularly the case when it comes to options, because this is just a perpetual futures. Spot is kind of similar, except you can't short the spot unless you short sell the spot, which is a whole other thing. Yeah, so, but with options, right, you have volatility, and so they're non-linear, they're actually non-linear in terms of like modeling their price. So, you know, you've got volatility coming in, and that creates a whole, and then it depends on like the stock price and then the volatility of the market and things like that. And so, yeah, pricing those are quite important. Okay, cool. So does anyone have any questions about the order book we covered there, or the this thing here, the charts? Cool. Any questions at all? No. Okay, cool. So this is a perpetual futures, and I think maybe in the next, actually no, I'll just quickly cover margin and stuff like that. So this little window here on the side, on the right, is where you actually submit orders, right? So you can, so this is in quantity USDT, like you could change it to Bitcoin, or you could change it to contracts. So one contract is 7 US. I like that actually. You could do contracts. So one contract is about, what did it say? It was like $10, or whatever that is. You know, one contract is that much BTC. Cool. That's cool. So that's cool. So how you trade is you've got market and you've got limit orders, right? When you want to open a trade. So a market order is one where you execute the trade immediately. So what that is, a market order takes liquidity. So what the market order is gonna do is I'll say I want one contract of Bitcoin, right? And I want one contract of Bitcoin. And so if I go long, so if I'm going to buy it, I am going to take from here. I'm going to take this. I'm going to get this price here, 630, and I'm going to take some of that from there. So let's just do it. Let's just do it. And so I go long. It's like, yeah, sure, cool. So I think it was still 630 there. So we can look at our positions, and here we've got our position. Now, flash close, which just means close the position, so get out of it. And so if we look at it in real time, right? Here is the line we got in, and here's the current price. So it looks like I'm in the green. Cool. I just made a random trading decision. No thought went into that one. Okay. So next, I want to sort of discuss what's going down over here. So this, it gives us the realized P&L, and how many contracts. I think fair price, which they calculate somehow. Estimated liquidation. So because I'm margin trading, essentially it's a little bit more complex because you're sort of like borrowing money in a sense, right? So this is how much I've funded the account, like $41, right? Now I'm trading with 20x leverage. So what that means is I can put a position on, and but you pretend that position is 20 times bigger than it actually is. Now that's great because you can get 20 times more the gains, right? But it's also bad because it means you get 20 times more the losses. So the liquidation price is saying that you will lose all your money in your you'll lose all your money, right, in your account here if on your position the price of Bitcoin hits 67, right? 67. But if it was 1x leverage, so no leverage, you would lose all your money on the position if the price of Bitcoin went to 0, right? If it went to 0. So leverage is a double-edged sword. So you really want to be careful about what you're doing there. Now, okay, so the unrealized P&L, so you've got, it tells you how much margin you're putting up. And so that's a whole thing I can go into later and how to calculate those margin calculations. But it sort of gives it to you here, and it tells you how much margin you're using. But I guess for now, just be careful with your position and things like that, and watch your P&L as well and manage your risk. So you've got the unrealized P&L. Now I'd be careful of this number. It's not that you made 1.68 in profit. It's kind of like it's not like that percentage is not comparative to, imagine if you had 20 times the account size, right? It's not you take this by how many ticks it is, and then it's not that. This price didn't move 1%. Essentially what it is it's how much distance is here multiplied by the leverage. So that is a bit tricky. You got to look out for, because it makes you think, I made 1.6%, which is actually an amazing trade, right? But it's not that. It's more like 1.67 divide by 20, which, so that'd be 7 basis points. Yeah, so 0.007%, right? So that is not much. Okay, cool. Now I'm going to talk about what's going on here, right? So I marketed in. I used a market order, so that took liquidity from the book. And you might actually see you've got maker and taker fees, right? So you get charged a different. So you get charged for trading every time, and on some exchanges these percentages will vary. But so every trade they take a percentage of how much you trade. So essentially, I got charged 0.01% of the volume, right, to place that take a trade or market order, which took liquidity. So that's why my realized profit, so realized means it has actually happened and they've already taken that money, is, in the negative here. But my unrealized profit is actually this, because it's been moving up so far. Now, remember, if I want to get out of the trade, I will have to spend realize that much of a loss, because the taker fee is actually is that so 0.01. Now, I'm just going to keep that there, and I'm going to talk to you about something called basis points. Basis points. So, this basis points concept is very important. Now, before we go and talk about basis points, I'm going to have a sip of my matcha, and I would invite anyone here to ask any questions at all about just the basics and the mechanics of trading and things like that. Any questions, guys? Any at all? Otherwise, I guess, shall we move on? I guess we shall. Okay. So I think maybe it also might be, okay, so I'm gonna just talk a little bit about percentages, actually. So let's get our terminal up. So I have Python open here, right? So Python is open, and I'm just gonna do a bit of calculations when I can. Now, I'm gonna change this to percentage, right? Now, what is going on here? I'm gonna sort of move the chart over here and just sort of talk about what's going on. So let's see. So where's 0? Okay, so we've got percentages, and now 0 starts at where the where this candle here at the start is. And then we think about price movement in terms of percentage, like percentage of price, which means, so if we go down this much, the price would have moved 50%. Where the price we got in was about, 1 point below, like, negative 1.1%, right? Okay, so that's great. Now, obviously, when we're trading on this time frame, we are sometimes dealing with percentages below 1. Here we're dealing about percentages around 1, but we're usually, like, if you're trading like short time frames and you're market making and stuff, you want to talk in terms of these things called basis points. Now, a percentage, right? You've got a percentage. Now, a basis point is 1% of 1%. So you can think about it like this, right? If you it's going to be, you take the percentage and then you times it by 100. So 1% is going to be 100 basis points. Does that make sense? I'll repeat it. 1% is going to be 100 basis points. So it's like 1% of 1%. So we take each percentage and break that 1% into its own percentages, right? And so now we can talk in terms of smaller things. So for example, the price right now is 1.03%. I would say that my language is more, I would be, okay, now it's at 1.06. I'd say that's 106 basis points. For me, that's quicker in terms of saying point, or when you're writing things, or when you're looking at things on trading screens, you want to make sure you compact as many numbers together as possible. So if we can remove that decimal place and just say 106 basis points, that is much quicker. Now, trading, like, even though it's such a small thing, trading is a fast game. So we need to compact our language as much as we can. So here, like, I'd be like, oh, the chart says 178 basis points, like, so that is another way of thinking about that. Okay, cool. So that is that. So that's basis points right there, which is great. Now, yeah. So actually, for me, when I think about trading, is so I've got this fee here, right? This taker fee, and I've got the maker fee. So we'll just care about the taker, which is the market order. So you take liquidity there. So if I go into a trade, right, and both ways to get in and out of the trade, I I need to make at least 2 basis points, because so to break even, I need to make 2 basis points. So 1 basis point for getting in and another basis point for getting out, right? And then so that length needs to be like 2 basis points at least to scratch. Scratch just means break even on the trade. If I go with a maker trade, which I'll explain very soon, I don't get fees. Cool. So when I trade, I like to think about percentages. Sometimes it's not very instructive to look at things in terms of how much profit you have, like in terms of USD, because first it's a psychological thing. It can be a bit of a distraction, and it's like, oh, I'm losing this much or making this much money, but it's more like you want to just see like how much basis points you're making, right? How much basis points you're making. And then the realized P&L in terms of USD doesn't even matter, because say if you're making 1% a day, which is huge, by the way, which is huge a day, like per day, you can make you just need access to capital to increase how much capital. So, like as a trader, you should be like, okay, I'm trying to get my how many basis points I win per day sort of consistent, instead of trying to make as much money a day. So what you would do is you try to get a consistent amount of basis points per day, like basis points 1 per day, right? And then once you are more confident with that, you'd obviously put more fuel on the fire and you can start trading with more capital. So, but because you're consistent, there's lesser risk you'd lose all your account, right? So so when I trade, I always think about things in terms of percentages and basis points. Yeah. Okay. Cool. So what I'm going to do now is I'm going to show you what a limit order is, and so this maker idea. So a limit order or maker, so a maker trade. So when you make a market, means you're going to put a trade on the order book, and you're waiting, fingers crossed, for someone to, we say hit your trade, and accept your price. So notice there's two entry things here, right? So you've got the price, right? And you've got the quantity. So I have one contract in my a position of one contract. So I'd want to sell one position at the moment, right? And then here, so the price I want to sell it at would be, I don't want to sell, so if I want to get filled quickly, I could sell it sort of here, right at the edge of the book, so at the best price. But if I want to, dictate the price and I want a better price, I could sort of sell it more up here, like up here at a higher price. And BBO just means the best bid offer, right? So I'm going to say that's the best price, and then I'm going to open a position there, confirm. And so it's in the market right there, and I'm waiting for someone, and you see the dot, it shows me it's in the market, and I'm waiting for someone to hit that. So, yeah, and so it just got hit, the dot disappeared, we got a notification right there, so things are going quickly, right? And so that was a successful maker trade. So that means because it was a maker trade, we didn't have to pay any fees, because our fees are at 0 for maker and 1 basis point for taker. Cool. And so position. Oh, what happened there? That should have closed the trade out, hey? Weird. That's weird. Hold on. I think I can. That's so weird. Huh. Okay. I think this is like hedge mode or something. Close. Open. What? So I just opened another trade. I don't like that. It opened like, it has two. Can I just close those? Reverse. That should have closed. It should have closed the trade. Yeah, so I guess you got to be careful. These such a scammy thing to do as well, because I should have closed the trade, right? because I had one contract. What? What is going on? Okay. Yeah, that's super scammy, by the way, because now they're gonna like, because of the inconvenience, I'm gonna be like, oh, just close the short, close the long. Okay. They might like give me a taker fee for closing it, so you gotta be super careful about this. This feature here looks really dodgy. Trading. It should have just closed the trade. Yeah, but the realized P&L was 0, right? Because it was a maker trade. So flash close means close at market, close short. Yeah, it's gonna make me... Ah, man, that is... I don't like that about an exchange. So there's a lot of fucking scams going around, and so this... Gotta be careful of what's going on here. So... Because I have these trades that cancel each other out, right? And technically I would have made a profit on it, but oh my god. How? Yeah, and so now because I have to close those out, I'm going to, you know, close it out at a loss. So that is unfortunate. So usually I don't trade on this exchange. I just thought I might. So I'm not actually used to this exchange, but that is dodgy as fuck. Dodgy. So got to look out for all this dodgy stuff here. But that's okay. So maybe let's do the example again, right? Can I just like zero out the trades? Isolated. Oh, it's because it's maybe it's, yeah, I probably should do cross margin, right? Cross. Yes. Apply margin mode adjustment to all futures. And maybe it closed it out? I guess not. That's weird. Okay, looks like I just have to close this. Close. And then, oh, this is not good. Like, all these pop-ups here, like, I don't, yeah, I don't display options. I don't want this. I don't want to share. Yeah, so you got to be careful. It's like a gambling site. It's not very, you know, it's like there's all these bright lights and bright colors, so you have to be really careful about that. That actually frustrated me quite a lot. So I'm gonna see what is going on. Why do we? Yeah, it should be like open, and then to close the trade, you need to like. Yeah, no, that's bad. Single asset, multi-asset, so trading pairs using the different settlement upon collateral. Yeah. So that tells us we can use USDT as collateral. Here it says we can use USDT, USDC, or other stuff. That's cool, but I don't want this. I don't want this open and close thing here. It's really annoying when you trade. You want, if you go short, you know, if you go, and it just calculates like, yeah, that's chase. No. So be careful about that. Be careful. Be very careful. It's this is usually called like hedge mode. Hedge mode. So let's go into settings. Single asset mode. Maybe that could be it. Oh no. Hot events, position mode, hedge mode. That is something you have to be careful of, right? So hedge mode is yeah, what happened there? So I opened 2 positions, and then now I could have done some more trading to sort of make a market, and then I get 0 fees. But it was just annoying because those positions weren't closed out. Normally you would just close those out because they cancel each other out, right? Because we're on hedge mode. But looks like the default is hedge mode, and I want one-way mode to be able to close positions, right? So I'm going to switch things to one-way mode. So watch out for that. Sometimes you've got to be careful because there are defaults on the exchange that are designed to make you spend more money on fees than you know, what is in your best interest. So honestly, I don't know, look at my P&L. What was my cash flow? So yeah, I got yeah, kind of. So I lost. Oh no, I didn't. Sort of. Yeah. So anyway, it's okay. So let me demonstrate it properly now. So the market is not moving at all, really. So there's nothing going on. So let's put a limit. So I just put a limit order trade there. So if I wanted to do this quickly, I put 1 there. The price there. Short sell. Now, okay, so you get this dialog box, which is like a confirmation. If you're, you know, trading properly, you want things to go quickly. You'd actually have like a trading screen or something like that. Professional traders have this software and stuff to actually trade properly. But so what I'm going to do is I'm just going to say never show again, and then I'm just going to reset the price because the price moved. So go here, click on that, and it'll update the price. Sell short, never show again. Sell short, cool. So there's my resting order there. I'm waiting for it to be filled. So there it is. Okay, cool. So that's the order. Now I just want to also note that the order book is at a sort of $10. You can make it $1 like that. So these are the prices are okay. So the price moved quite a lot away from my price. So I'll just go back to 10. Go back to 10. So it moved down a bit. Now what you could do is you could adjust the price of your order. There's 2 ways to do it. You can just kind of grab that, move it down, or you could go here, orders, go to your price, which is here, order price, edit, which is not an option, which I think is ridiculous. Oh no, here it is. Well, that's oh my god, that infuriates me. You have to cancel then edit. How bad is that? How bad is that? Okay, it's okay. We just wait for it, no problem. Any questions? Any questions while we wait for these things to get filled? Arcs away, arcs away. Arcs away. You know what? Let's go to the minute chart because we're trading. Yeah. So the price moved quite a lot. Market's still at the moment. Any questions? Otherwise, I might just move this down so we get some action going on. Otherwise, no, it's still like. So let's move this down here. Changing the price. Yeah, don't remind me. One way. One way mode does not support. Oh my god, how ridiculous is that? This is like a scam. It's like a scam. There's everything good you want in an exchange is like it doesn't support it. And then it's like all the common mistakes you make. You know, like things that you could possibly make mistakes on. How bad is that? What a scam. So bad. So bad. I have to cancel it. And then I have to make another order. So I could make one there, one contract, sell short. Yeah. I can't believe it doesn't. So this is, so you see the price going down at the moment. That's some of the bad things with limit orders, right? So maybe I wanted to get in short, but it missed the price, right? And then now I'm just stuck with no order in the market. See, like I didn't get in at the price, and it's going down. A lot of volumes coming in, and so we've probably missed that momentum there because you know we've got a green candle. Not trading advice, by the way. Not trading advice, but just market observations. So you know it might come up a bit. I just want to show that you can close out a trade. So watch out for hedge mode. That'll that'll ruin your life. That'll ruin your life. Okay, cool. It's coming up. Market's moving up. Probably like 1 tick or so away. What is it? Yeah, 58, and I'm at 60. 59. Yep, it's coming. Gonna hit it. Yep, filled it, and then the price pushed above my price, pushed up, and then say I want to now say I want to buy out of that position. So if I buy now, I'm actually losing money, right? I'm at a loss. So I short sold, and then the market's going up, so I'm losing money here, right? So look at the position. Yeah. So you can sort of, so we can actually calculate like how much we're losing. So in terms of basis points, I think this might be a good exercise, right? It could be a good exercise. We want the difference between that and that, right? So let's go to Python. It's probably overkill, but I'm just going to import NumPy because I just love NumPy. So import. Oh, lovely. Hello. How are you doing? Lovely to have the first comment. Love it. So import. So anyway, is that your bank account spreadsheet? No, there is no spreadsheet at all. No, not at all. We are just showing the basics of trading dynamics, understanding, the limit order books, last trades, the difference between, like limit and market orders, the difference between taking liquidity, providing liquidity. What are you investing on? I do not want to give financial advice. This is not me investing. It's just me showing people how trading platforms work. I do not want to, on a stream, I don't want to give financial advice to anyone. Okay, cool. So we import, are you an investor or trader yourself? So import NumPy as NP. Cool. Hold on. No module name NumPy. That's okay. We'll just use math. We'll just use the math. So I'll just go import math. Cool. And so what I'm going to do now is, you're definitely a numbers man. Yes, I am. I am. So we're just going to do that simple exercise of trying to calculate how many base. Oh my gosh, we've lost so much, right? So we bought in there, and now the market is, it's really moving up. Well, I've gambled for 15 years and left it all to chance. That's not good. That is not what we do at this channel. No, we don't. Don't endorse that. That's okay. So anyway, let's get back to this exercise. So the entry, so we're just going to write a little Python program here. So the entry was, so what's the entry? What's our entry price? So the average, so it's 70.66, right? So 70.66. Yeah. Let's just make it a float. And then, we'll just say P for the price now. Actually, let's see how many. So we traded, so one contract is three decimal places of a Bitcoin, I believe. Is that what it said? Futures contract, no, four decimal places. So let's do that. Suppose it's a form of gathering cash in one form or another. Yeah, I guess. Yeah, but I do not endorse that. Do not endorse that. You got to use, your skills of statistics and probability to put the probabilities and edge in your favor. Anyway, so I'll just say the volume here is going to be 0.001 of a Bitcoin, and then the price. Let's just take a snapshot right now. So the price is so what's the current market price? We'll just say 7075. We'll just say 7075. 7075. And then we'll just leave it at that. 7075. Because the market's always moving. 7075. And then yeah, so okay, to calculate the P&L, so what you got to do is to do this, you just go the entry. So this is a short position, right? So usually you'd go the exit price. Sorry, so for short position you go entry minus the price at the moment. But if it was a long position, you'd go the exit price minus the entry. Okay. Cool. That is a lot of, you know, that's a big loss. That's okay, it happens. We're not actually trading for strategy, we're trading for education here, so don't worry about it too much. Okay, and then you want to divide by the volume, and that should give us the P&L in USD, in USDT. That is not right. That is not right. It is because that should not be a division. It should be a multiplication. That looks better. That looks better. So that's how much USDT we have lost. Yeah, that's how much USDT we have lost. Now, let's think about it in terms of percentages, right? So not putting, you know, a USDT amount on it. So the way you do this is, oh, it's coming back. Whoa, look at that candle. You take the difference, right? And then you would divide by this value here. So the sort of the actually you divide by the entry. That's a better way of thinking about it, right? So you can go P, right? It's just sort of a way to anchor things, or you could take the middle of that, but usually it's the entry. Great. And then so that is just sort of like a difference. Oh, cool. Looks like we're in the green. In the green. Look at it go. I might actually just I might just put a limit order there real quick. Oh yeah, look at that. I should have put a 1 there. So we want to buy 1 contract at that price. Yep, and it's gonna hit it. It's gonna hit it. Ah, no, it wicked up. It wicked up. It did not hit it. I missed it. I missed it. I missed it. I should have maybe I should have marketed. I missed it. That's okay. Ah, and I'm gonna scratch there. I'm gonna scratch there. It's okay. Happens. It happens. Okay, so let's just get out of the trade. Let's get out of the trade. 1 contract, buy long. Is it gonna come down or go up? I kind of want to close this position out. I just don't have dangling orders. Okay, anyway. Yeah, so that is so that's sort of the raw difference, right? To convert it into percentage, what you need to do is just multiply it by 100. So so what this is saying here is that so at that snapshot I took just before, we lost 0.06% on the trade, or 6 basis points. And to convert it to basis points, you just need to times it by 100 again, right? Or just times it by 10,000. And so what this says here is that we have lost 6.3 basis points. Cool. I'm going to just mark it out of this. I don't want to have any dangling orders there. Okay, does anyone have any questions at all? Because that's sort of the basics there. I think it might be I think we've covered like most of the basics. Oh, one more thing, maybe the depth. We didn't really cover that. So we've got these views here. We've got the order book, and now we've got the depth. Now, so this depth here is just a visual representation of these numbers here, right? So even you see these like things highlighted. This highlighting here is just this going up there. And what it is essentially is like it's a snap. It's showing what's happening in the order book. So so you've got sort of the total amount. So here you've got the quantity at this price, and then here you've got the total like looking back. So looking like the cumulative total there. And so, you know, this volume represents how many contracts are in the market, depending, you know, sort of depending on the price on the x-axis, right? So if I can zoom in, can I zoom in? I don't know. So that's the spread there. That's a visual representation of the spread. So the spread's pretty small, right? Yeah. So sort of the spread is small, like, you know, for the first few levels, but, you know, going out, it gets a bit bigger. So it looks like there's a wall here. There's big people coming in, and then they sort of make a wall right here. So what that might say to me is so this might be homework. It's called market making. So I used to do this back in the day. So market making facilitates you know, people being able to buy and sell on the market. So when you have like walls like this, that it goes up steeply, and maybe you've got two of them, it might mean that you've got a market maker putting like this, right? This, like now look at it now. A market maker trying to put bids and offers, and then what they do is they hope people buy them, and they will capture the spread as profit. Sometimes and then when you're a market maker, you want to make sure that your risk is you know, your risk doesn't go out of hand, because imagine if people keep hitting this side, then your risk is skewed, like you've got too much risk here. And so what they would do is they maybe adjust how much they put there. So maybe so that's when you get things like that are one-sided. Yeah, like that. But it all happens very fast, and honestly, you probably can't do that just sort of manually trading. You need you need to code it up, and that is actually my whole thing. So I do have a school community here, Coder Trader. It teaches like, so this was sort of basics of manual trading, but I go into sort of teaching like teaching coding and trading and stuff. And we've got these courses here, and so the first introductory course is just this build a trading system in 7 days. So everything we do is going to be just getting Python or Go or whatever language you choose, right? Whatever you become proficient at, or even if you're a beginner, you know, we'll get you coding to get the machine to do it. Okay, cool. We've been streaming for quite some time, almost an hour. I'm going to call it. If there's no more questions, I am going to get out of here and get on with my Saturday. So I hope everyone has a lovely Saturday, and I will see you in the next stream.